And oh, okay. 1 second, guys. I hit the wrong button, I guess. 1 second. I hit the button that says leave the meeting rather than the one that says that I accept the recording, and I need to have my monitor on. So 1 second. Okay, can you hear me okay?
Yeah.
Okay, all right, good. All right, so we're gonna go ahead and jump in, and the game plan for tonight is to finish up chapter 2 and then get a good start on chapter 3. We're about a chapter behind, so we'll just keep plugging away at that so that we can kind of keep it close as to how we move through the chapters. Okay, so that's the game plan for tonight. I want to go ahead then and put up the PDF for chapter 2. And let me get this out of the way as best I can. Put us in tablet mode. Say my Hail Mary. Enough. 1 second, guys. Didn't pray hard enough. Okay, you can hear me? You can see me? Yeah? Okay. Okay, good. All right, so let's go ahead and let's take a look at module 6 now, which is where we left off last time. And what we're going to be talking about here is special purpose framework. What happens? Under generally accepted accounting principles, we follow accrual basis accounting, right? But some companies may not have a need to prepare a full set of accrual basis financial statements. For example, a smaller company may want to prepare cash basis financial statements. So that's perfectly fine. And, of course, they're not going to list on the stock exchanges, but for their specific purposes, maybe cash basis would be fine. So the main thing we're going to be focusing on here is if a company has to prepare statements using something other than full accrual accounting, what will we call the balance sheet, the income statement? Basically, that's what we're talking about here, because you're not able to call it the balance sheet and the income statement unless you're using full accrual statements. So that's pretty much all we're talking about here in the beginning of module 6. Module 6 ends up being a module that gives students some trouble because as part of this, we also discuss how to turn a set of accrual statements into a set of cash statements and how to convert a set of cash statements into a set of accrual statements. And I know that that's a little problematic for students. And I think the problem is, the reason is that there's nowhere in the text where they say, do this to turn accrual into cash, do that to turn cash into accrual, do that. And I have a couple of flashcards for you that I'm going to I've already made the flashcards for you. You just need to get them into your flashcards. You need to memorize those cards and then use that process every time you get one of these problems. Now, if you don't make the flashcard that I'm asking you to, if you don't use the flashcard that I'm asking you to, if you don't memorize it and apply it to the problems in this area, then you will continue to struggle with this and it will be a problem for you on exam day. So remember, when I call it a flashcard, if you've got one made already, which in this case, Becker hasn't made a flashcard like this, fine, you can use Becker's card. But if not, you need to make the card or download the card that I've made for you and use that to help you work the questions, okay? Okay, but let's go ahead at a higher level here, and let's just begin talking about what are some of the special purpose frameworks. And basically, we have something called other comprehensive basis of accounting, which is essentially a non-GAAP presentation, meaning that we're not using full accrual accounting. So you see, we could have a cash basis or modified cash basis. Some entities may prepare their financial statements on the tax basis. Okay. Sometimes an entity may want to prepare their financial statements following a regulatory basis. I say they may want to, they may be required to by a regulatory agency. For example, if you're an insurance company in the state of California, there's a requirement that you file financial reports with the state Department of Insurance. And so you are required to follow the accounting principles of the National Association of Insurance Commissioners. And those requirements don't allow you to capitalize certain assets like office furniture because they're trying to get a more conservative picture of an insurance company for those filings. So that would be something that would be different than GAAP, would be a regulatory basis. Okay. Now you come over and let's just take a look at general presentation guidelines. And this is where I want you to focus your flashcard for this, and that the financial statements should differentiate the other comprehensive basis of accounting. So the required financial statements are equivalent to the balance sheet and the income statement, okay? But we don't call them the balance sheet and the income statement. We're going to see that here in a couple of minutes. Financial statements should explain the changes in equity accounts for the period. A statement of cash flows is not required. And then there will need to be disclosures in the other comprehensive basis statement as to the fact that this is not GAAP, this is an other comprehensive basis of accounting, the summary of significant accounting policies, and then informative disclosures that are similar to those that you would see with GAAP. So you're still going to have similar disclosures, but you're preparing the financial statements following one of these other comprehensive bases, cash, tax, regulatory, whatever it is. And then we're going to see that we are going to have to use different titles for the balance sheet income statement. We can't call it balance sheet. We can't call it income statement. And so they're going to get a little wordy in how they, word these. And we're just going to have to sort of just remember, don't call it a balance sheet. Don't call it an income statement. Now, cash basis and modified accrual cash basis entities that are not required to use the accrual basis may use cash or may use a modified cash basis. And we'll talk about the difference between cash and modified cash. Note that cash and basis is not something that you would expect for complex operations. So we're talking about very simple, probably primary cash businesses that would go ahead and prepare a set of cash statements. So you can take a look at the next page under the cash basis of accounting. Revenues are recognized when cash is received, and expenses are recognized when cash is paid. So the thing that I work very hard to, force my introductory students to forget, to remove from their mind, is something that we're going to be doing when we're dealing with a cash basis. The way we determine revenue expenses is cash being received, cash being paid. Okay. They tell us that cash basis is generally used by estates, and trust is a good example there. I have a friend, a former student, really, GGU alum, Becker alum, actually, now that I think about it, that is a controller for a trust. And she was telling me, I don't even know if I remember my accrual accounting anymore, because we basically use cash basis as we disperse funds from this family trust that she works with. Okay. Okay, good. So let's just go ahead and take a look at the statement of cash and equity. Okay. So in a pure cash basis financial statement, cash is the only asset, no liabilities are recorded, and equity is equal to cash. Okay. So that basically is LIKE, like the balance sheet, but we don't call it a balance sheet. That name is reserved for GAAP statements. So we don't call it a balance sheet. We'll call it a statement of cash and equity. Statement of cash receipts and disbursements. And let's just go ahead and write in here just so we understand that there, through analogy, we're talking about something that is like the income statement. Okay. Sorry, guys, my phone is back here buzzing someone. I never ceases to amaze me how I can sit here all day. The phone will never ring. Let me start class. Somebody decides that I'm the person they need to talk to. Okay. Anyway, we come over and statement of cash receipts and disbursements include the following: revenue received, debt and equity proceeds, proceeds from asset sales, expenses paid, debt repayments, dividend payments, okay, payments for purchases of assets. So you look at that and you're like, on an income statement, really? Yeah, that's cash basis. If we purchase equipment under accrual basis, don't you dare put that on the income statement, right? Cash basis, those are the kinds of things that you're going to be reporting on the income statement. And we're going to see how we would have to turn cash net income that would be reported on a cash income statement to an accrual income statement here in a couple seconds. And you'll see that it'll address a lot of these things that you're like, huh, really? We would actually put that on an income statement? Yes, we would. Okay. Now we come over and we talk about modified cash basis. And basically, it has elements of both cash and accrual. And so let's just look at some common modifications, guys. And I'm going to ask you to flashcard that for modified cash basis financial statements. And we will now, instead of treating purchases of equipment as an expense and reporting on the income statement, we will capitalize and depreciate that. We'll accrue our income taxes. We will reconcile liabilities for long-term and short-term borrowing and related interests, or I should say record liabilities. Capitalize inventory, report investments at fair value. So just some basic differences, things that you would do if you were going to prepare a modified cash basis. Okay. Now, modified cash basis financial statements include a statement of assets and liabilities. So, guys, I'm asking you to flashcard the names of the things that are like the balance sheet and like the income statement. Did I do that up there? Okay. Just flashcard these names, okay, of the statements that are like the balance sheet, like the income statement, under the cash and modified cash basis of accounting. But to be honest with you, just make sure you don't call it the balance sheet, you don't call it the income statement. And so when you start getting into this sort of long-winded title of the account that says revenue and expenses from cash transactions, you would know that you're talking about the cash income statement. Just know that you don't call it the income statement, you don't call it the balance sheet, because that's reserved for accrual statements, for full GAAP statements. Okay. Now, if we're dealing with income tax basis, then an entity would prepare their statements using the same principles that they would use to prepare their tax returns. So if we collected cash, but we hadn't earned that cash yet from an accrual basis, that's a liability. For tax purposes, that would be what? That would be considered an income if you're a cash basis taxpayer, right? Okay. Okay, good. Again, the presentation, and they start coming up with these long-winded titles for the balance sheet, long-winded titles for the income statement. And I think by now you're seeing that that's pretty easy. We've sort of repeated here now several times. Don't call it the income statement. Don't call it the balance sheet. That's the key thing to remember, but you could also flashcard the names of these statements to help you answer any questions. Okay, questions? All right, so that's really just dealing with what? Just presentation, calling out the other comprehensive basis of accounting: cash, modified cash, tax basis, regulatory basis, whatever it is. And the fact that we don't call the balance sheet and the income statement by those names, we use some long-winded name for that. Okay. Now, again, as I said in the little introduction, the area where I see a certain amount of problem for students is right here. Okay, converting the cash basis financial statements into accrual basis. This is really why I didn't want to get into this, even though we had a little bit of time left last time, because I don't want you to try to figure this out while you're a little bit tired. Now, the thing that I think is the problem is the way they present the information in the book. There's not this sort of one stop, what am I supposed to do to convert my cash basis financial statements into the accrual basis? They kind of jump all over the place and give you all these different tables. And you can almost feel the authors of the book struggling to figure out how to give you that sort of one thing that will help you to be able to answer all the questions here. Okay, so what I'm going to do is basically take you to the income statement conversion, okay, from accrual to cash. And they start giving us a lot of different things and formulas and the beginning balance and the ending balance and the explanation. And I'm kind of like, I think this is why people are having trouble, because they can't really seem to articulate something that to me is just a very simple flashcard that you make and you just remember. Okay, so if you're sitting there and you have a question in which they're asking you to convert your cash net income to accrual net income, and by the way, this works for revenue as well. Okay, all you have to do is start with the cash net income, which the question would give you. Sorry, guys, I don't know what's wrong with this. Ever since that other computer started having problems, my life's been miserable with its files, always wanting to have me do something else other than what I'm doing with them. Okay, so cash to accrual flashcard, and this works for revenue as well. So you could start with accrual net income, you could start with accrual revenue, okay? And you're going to go through and they'll give you a series of things that have change for the period. And so they'll maybe tell you the change in accounts receivable, the change in accounts payable, which are current assets, current liabilities. They may talk to you about the change in the unearned revenue, which is essentially a current liability. Okay, so what do? You start with cash net income. And for current assets, I tell you to do the same. Okay, in other words, if the current asset increases, then add the increase to net income. If the current asset decreases, then subtract the decrease. So just remember what? For current assets, do the same. If they increase, add them. If they decrease, subtract them. Okay. For current liabilities, do the opposite. So if the current liability does what? If it increases, then subtract the increase from net income. If it decreases, add the decrease to net income. So for current liabilities, do the same. Always subtract depreciation, add any fixed asset purchase, subtract any long-term borrowing. If you follow this and you practice with this on the questions, guys, you'll get good at this. And what'll happen is the examiners will think that they're giving you an area that you're going to struggle with, and you're going to knock every single one of these questions out very quickly. So it will also be a time saver for you. Okay. Now, this flashcard is up on e-learning. Okay, so you don't have to have that now, but it's already made for you. All you got to do is kind of cut it out, make it flashcard size, put it with your flashcards, practice with this, use this technique, you're going to be in good shape. Okay, but just to help us to see how to apply this, what I want to do is go back to the text here for a second. Put me back into full screen. Okay. And again, I don't like that adding the beginning and subtracting the ending and minus unearned, because if they give you the ending, they give you the beginning, well, you can calculate what the change was for the period. And I told you what to do with the change. So it's less calculations than what they're showing you there. So that's why I don't like this converting cash basis revenue to accrual basis. And the way they've talked about that. And I'll talk about cost of goods sold and expenses here in a minute, but I want to go straight to this one now, which is related to net income. So again, I gave you for revenue, which I'm passing by the way they did that for revenue, because it works the same way as net income. And let's just go ahead and see if we can practice what I just said on the flashcard for you, if we can see it right here. Okay, so they give me the cash basis net income, right? And they tell me in the required to what? And they tell me to do it for revenue, expenses, and net income. Guys, I'm not going to do it for every single one of these because we don't have all night to sit here with this. And I've told you how to handle it for revenue, and I'm going to tell you how to handle it for expenses here in a minute. Okay, so let's just go ahead and let's just deal with the net income part. So the flashcard told me to do what? Start with cash net income, which was how much? 30,000. Then the flashcard says what? For current assets, do the same. So what happened? My accounts receivable did what? It went up, didn't it? Didn't the accounts receivable go up?
Yes.
Okay. So what do? I go ahead and I follow the instructions. I do the same. Since the accounts receivable, which is a current asset, went up, I add it, right? Okay. Then I look at the prepaid insurance, and the prepaid insurance did what? It also went up. So I follow the directions and I add it. Okay. My unearned service revenue did what? It went down for the period, didn't it? So the flashcard tells me that for what? For liabilities, do the opposite. So since it went down, I'm going to do what? I'm going to add that because I do the opposite for liabilities. And then they tell me what? Salaries payable did what? Salaries payable went up. So I'm supposed to do the opposite. I need to do what? Subtract it. Good. And then they tell me what? They purchased a piece of equipment for 5,000, and it tells me what? Add fixed asset purchases is what I'm supposed to do. So I have to add that 5,000.
Yes.
And when I do the math. Now I pull out my calculator. I started with the cash net income, and I arrive at the what? I arrive at the accrual net income, which is the answer to this question, which is 52,000.
Do we need to subtract the depreciated?
Well, they didn't give me depreciation in this question, did they?
We
They did.
do straight line basis over 5 years.
Um,
The paragraph under the numbers.
oh, yeah. Okay, my bad. I skipped that. Yeah, so it won't come to 52,000. Thank you. So the depreciation piece of equipment, they paid 5,000 cash for it, right? Which I've added back the cash that they paid for it, and it's 5 years. I'm assuming it has no salvage value here. Okay, so what's that, $1,000 per year?
Yep.
Yeah.
Okay, so we have to do what? We have to always subtract the depreciation, right? Thank you. Okay, good. And so then that should add up to 52,000.
Does.
Okay, good. Thank you. Okay, now I'm not going to do the revenue for this one and the expense for this one. Revenue would be the same thing, but it would just be what? Items that affect the revenue, right? Okay, so you would just go through and do basically the same thing with the revenue in terms of how you treat each of the elements there, okay, that affect revenue, which is your accounts receivable and your unearned service revenue. Expenses, I'm going to show you what I want you to do with expenses here in a second. Question. Okay, good. There's no question on that. Then I'm going to go back to the flashcard for a second. And I want to show you what I put down at the bottom of this flashcard right here. And we'll talk about accrual to cash here in a second. But just down here, if the problem is just asking about revenue, say accrual or cash to accrual, accrual to cash, follow the rules above, analyzing related accounts that affect revenue, which is essentially accounts receivable, unearned revenue, and cash. If the problem is asking about expenses, then you need to reverse those rules. So let's go back because I put that down here, but rather than type it out on this flashcard, now I'm going to go ahead and use the textbook material for this. So come back and let's just look at what the book tells us about that part I skipped, which was the expenses and the cost of goods sold. So let's just come back, see where that was, which I can't seem to find it now. Page what? Page 38. So come back to page 38. I guess down to page 38. Where am I? No. I guess it's not page 38. Okay, so revenue, you use the same rules. Okay, let's look at expenses first. Okay, so converting cash paid for operating expenses, and what I want you to write in there, because again, they give us a lot of information, but just right here for assets, do the opposite. For liabilities, do the same. Okay, so you can see why I put on the flashcard, but now I'm also using the same sort of rhythm of speech here. For assets, do the opposite. For liabilities, do the same. And it's the mirror image of what we do for revenue and for income. And when you think about it, what's the reason? Well, revenue and income are essentially what? Increased by credits, aren't they? Whereas expenses and cost of goods sold, which is like an expense, it reduces net income, but we call it cost of goods sold, are what? Are increased by debits. So that's why you have to do the opposite for those of what you do for revenue and for income. So I'm simply flipping the rules now if they're asking us something about expenses, if they're asking us something about cost of goods sold, which is up here. For the cost of goods sold now, what? For assets, do the opposite. For liabilities, do the same. Okay. All right, guys. So, there was a time where I went through and gave a bunch of examples with journal entries on this and stuff. And I really think the way to attack this for CPA exam is to sit here and use these flashcards, use these rules to do all of these conversion of cash to accrual questions. You've got these flashcards here now that I've talked to you about. This is another flashcard here. You've got these flashcards that I talked about. Make them follow those rules, guys. And what starts to happen, you struggle with it at first, and then you do it enough times, and all of a sudden you're like, okay, I got this. And you're going to be in a position where you're going to be able to get through questions like this pretty easily, pretty quickly on your exam. Okay, question? Okay, let's just go ahead then with all that. And let's take a look at a couple of the multiple choice questions, okay? If you need to refer to that flashcard that's on eLearn, go ahead and do that now. See if you can kind of remember the flashcard already, because you're going to have to memorize it. And that would be helpful too. If you got it memorized while we're doing the class questions, then that's one step in the right direction, okay? But let's go ahead and let's see if they make me do, yeah, I can do the poll over here. And I'll give you about 3 minutes with these. These are a little bit tougher than the usual. Guys, let me stop real quick. Let me jump in real quick. I realized something as soon as I put that question up, and I was going to go ahead and let you work with that for a second, but now I've decided to not do that. Okay, so and this works the same for revenue here. Okay, because this question, after I've gone on and on about cash to accrual, this one is what? This one is, no, this one is cash to accrual. Never mind. I thought it was the opposite. Never mind. Go ahead. Never mind the man behind the curtain. Go ahead. This is cash to accrual, what we've been talking about.
The poll is not up.
Really?
It was up, but when you switched back, it didn't come back up again.
It's still up for me.
Oh, I know why. I submitted it. Never mind. It goes away when you submit.
Okay.
Weird.
For some reason, it doesn't show on my main computer, but it shows on my monitor computer. I can't figure it out. Okay, good. Let's go ahead. Most of us have had a chance to take a look at this one. And so I'm going to go ahead and end the poll. And I'm going to share the results. And yeah, that's a pretty good turnout for a question that's pretty tough. Okay, but let's go ahead and the answer is C. But let's just go ahead and let's work this one together following the rules of turning a cash basis into accrual. So they tell us Ward collected what? 200,000 in fees, and that's essentially telling us what the collections are. That's what the revenue would be following cash. Then they tell us at December 31st, year one, Ward had accounts receivable of 40, and at December 31st, year two, it was what? 60,000. So it increased what?
20,000.
It increased 20,000. And so since it's an asset, I should do the same. I add it, don't I?
Yep.
Okay. Okay, good. Then they tell me that at December 31st, year two, Ward had accounts receivable 60 and unearned fees of 5,000. Now, I'm not in love with that wording, in all honesty, because they're not really making it obvious to me the change in the unearned revenue. But I guess I'm stuck here assuming that they had zero before and now they have some unearned revenue. So they have a liability that went up. And so if it's a liability, I do what? I do the opposite and I subtract it and I get the right answer that way. You know, I'm of the opinion that they should have done a better job wording this, or they should have got rid of this choice. Then I would say, okay, they're okay with the way they did that. The fact that they have D there leaves me kind of in the dark a little bit of, well, did it increase or decrease? I think a logical conclusion would be that it must have increased for the period they tell they had the unearned revenue. But I would have rather than said unearned revenue was this, now it's that, to make it very clear as to whether it was an increase or decrease. Question? Okay, good. Let's go ahead and let's try this one then. I'll relaunch the poll here. Guys, this is now the other flashcard, the other piece of that flashcard. So let's look at that real quick. So come down, come back to this flashcard because this one is now going the other way, which is asking what accrual to cash is what they're asking us for here. Okay, so if you look at this, start with accrual net income for current assets, and it's the mirror image of what we were doing from cash to accrual. That should surprise you. For current assets, do the opposite. For current liabilities, do the same. Always add depreciation, subtract fixed asset purchase, and add long-term borrowings if you're going from accrual to cash. So it's the mirror image of what we did a minute ago. Okay, so with that, let's go ahead and let's look at that question in the book that we were just working on. Okay, it looks like most of us have tried this one. So why don't we go ahead and take a look, and most of us got it right. Okay, go ahead and end the poll, put up the results. So the answer is A. Okay, I generally would like to get a 75% correct on that, but since we kind of quickly reviewed that just before in the middle of this question, that might be part of what's going on here. But we start with the flashcard tells us to start with what? Start with the accrual basis net income, which is what? 100,000. And now to turn it into what? To turn it into cash basis income, we're going to have to do the opposite of what we were doing when we were going from cash to accrual. So for my current assets, I will do the same. So it tells me that what? Accounts receivable had increased. Excuse me, I'll do the opposite. Accounts receivable had increased 100,000. So I'm going to do what? Subtract it. Okay. And then they tell me that what? Accounts payable had decreased by 6,000. So for liabilities, I do the same now because I'm going from accrual to cash. And then they don't tell me anything else about depreciation or anything, those items that I would have to consider if they gave them to me. So this is now what, 84,000? Okay. Now, interesting here where they're asking me to go from accrual basis to cash basis. It's not until chapter 7 when we do the statement of cash flows that we're going to revisit these rules and use them again for preparing a statement of cash flows. Because when you are trying to provide cash provided by operations, you're starting with net income and you're making adjustments for changes, which is the same thing essentially we're doing here. Okay, so this is very similar to what you would do if you're preparing a statement of cash flow. So this will pay, no pun intended, dividends to us later when we're dealing with statement of cash flows that we've taken this approach. Okay, so you've got to get comfortable with these flashcards, and the best way is to make the card, memorize the card, apply them to the variety of problems you see here, and you can turn an area that I think drives some students a little bit crazy, you can turn it into an advantage for you. Question? Okay, good. So let's go ahead and I'm going to stop sharing the poll and let's take a look at the next module, which is ratio analysis. Guys, I'm going to ask you to review for homework. I don't like to sit here and just call out a bunch of ratios to you with our valuable time together. There's a lecture there that you can review. At the end of the day, you have to flashcard the ratios. You have to be able to apply the ratios to questions. You can expect a task-based simulation that expects you to know these ratios. Now, the beauty of making all the flashcards for all these ratios, and by the way, I think you already have them in your Becker material. They give you a financial statement here, and then they start asking you to calculate current ratio, current assets divided by current liabilities, et cetera. And you can see why, you know, me sitting here and reading this off to you isn't of much use to you. You have the flashcards that tell you what the ratios are. I'm sure Becker has those in your stack of flashcards. Have those, have them available, memorize the ratio, and then come in and work the questions here, and you'll be in good shape for the ratio. But I don't think we need to sit here and go through it together. Okay. Okay, good. So since we're done with ratio analysis, at least for tonight's class, now we can go to module 9, dealing with partnerships. Now, I can't explain to you, and I know some of you joined the Facebook group of geniuses that talk about different things for the exam. And the thing says on there that it keeps coming up. Partnerships aren't on the exam, right? Yes, they are. Partnerships are still on the exam. There was never any discussion that they were going to remove partnerships. Maybe people got partnerships mixed up with pensions or something, since they both start with P. So I'm not exactly sure why somebody started saying that these would not be on the exam, but they are. Okay, I want to stop sharing the results here. Okay, and so we're going to talk about this. Now, what's interesting, I think, about the partner questions, they're kind of fun once you kind of get used to them, because you get to apply some basic algebra to sort of find the unknown is all you're doing in these questions. And so it's actually, once you practice with these and you start to get better with these are actually kind of fun questions. Okay, so we're going to talk about how to admit a partner. Then we're going to talk about how to exit a partner. I don't know, kick a partner out, retire a partner. Okay, is maybe a better way to say that. Okay, so we'll talk about that. And then we'll talk a little bit about what happens if we are distributing profits in a partnership. There are 3 methods that you can use to admit or exit a partner, for lack of a better term. I'm sure there's a term for that, but I can't figure out what it is right now. But exit a partner. And the 3 methods are the exact method, the bonus method, or the Goodwill method. And it's pretty easy to apply these. Our job is to know which method the exam question wants me to use. So let's just go ahead and let's take a look at the different methods, okay? And let's see what they tell us about these. And first, let's look at the exact method, okay? And let's just jump straight down to a pass key, and they finally give me a pass key that is worth something. And so go ahead and flashcard this pass key for a change. I usually don't pay attention to those because I don't find them particularly helpful. But for this one, it is. If it's the exact method, they won't say use the exact method. They'll ask you, how much will the new partner have to contribute in order to have a, whatever it is, 25%, 33% share of the partnership, okay? And so once you see that, you know that you need to use the exact method. And so let's just take a look at this question, and it's ABC, our partners in a 3-person partnership. They have capital accounts of 20, 30, and 50 respectively, and that's A, B, and C. And now they're going to admit D as a new partner, and D will get a 25% interest, and they want to know what should they contribute in order to get that 25%. Now notice they didn't call out the exact method, but we know it's the exact method because they asked us what do they need to contribute. So the way we'll set that up is we'll say, okay, the equity of the new partnership, which is something we're going to have to calculate here, is going to be A's share, which is 20,000, plus B share, which is 30,000, plus C share, which is 50,000, plus whatever it is that D is going to have to bring in. And again, it's our job to figure out what it is that D will have to bring in. Now, if you take A plus B plus C, that totals up to what? 100,000. And then when D comes in, D will come in with whatever is necessary to give them 0.25 of the total new equity. And so we set up that total new equity equal to what's already in there, plus whatever it is that D's going to have to contribute, which is our job to figure out here. So what do? They go ahead and they subtract 0.25 of the new equity from each side. So this is 100% of the total new equity. If you subtract 0.25 from each side, then the 100,000 is now equal to 0.75 of the new equity. Now you're home free. You simply divide each side by 0.75. Total new equity then is what? Is 133,000. And since there's already what? 100,000 in there, or if you just took 25% of the 133,000, that means D has to contribute 33,333 to get a 25% interest in the partnership. Question? Okay. Okay, good. Not too bad, right? You can see how that might start to be fun. Now, if it's the bonus method, they will either have to tell me to use the bonus method. Okay, so just write this in. Problem will say use bonus, or don't use goodwill. Okay, we've got three methods, exact, we've seen bonus and goodwill. And if they want me to use the bonus method, they're going to tell me now what the new partner's bringing in. So that's how you know, oh, this is not the exact method. I'm going to have to use bonus or goodwill. If they're telling me what the new partner is going to bring in now, I'm not having to calculate that. And then they're going to have to instruct me to either use the bonus method or tell me don't use the goodwill method. Or if they want me to use the goodwill method, they'll have to say don't use bonus or use goodwill, right? Okay. So when they tell me what the new partner is bringing in, and that's what we're going to see here. Okay. We don't need all these silly passkeys up here. Let's just take a look. And they tell me that A, B, and C, A and B share profits 60-40 and have capital counts of 30 and 10 respectively. C has agreed to invest $35,000 for a 1/3 interest in the new ABC partnership. Since the partnership has decided not to use goodwill, okay, so now I know I got to use the bonus method because they've told me what C is contributing. And so it's not exact. And they told me don't recognize goodwill. So I'm only left with the bonus method. The capital of the resulting partnership will be what? 75,000, 30 for A, 10 for B, and 35,000 for C. C has purchased a 1/3 interest, okay? So C has what? Purchased something worth 25,000, but what's happening? The extra 10,000 must be a partner, must be a bonus to the old partners, right? Because he's bringing in 35, but he's only getting a 25% interest in something that's worth 75,000. So he's only getting what? 25,000 worth of value. So what happens? You come in and that 10,000 bonus, 60%, right? Just following up here, is supposed to go to A. 40% is supposed to go to B. So we credit their capital accounts for that. C gets credited to their capital account for the 25,000, and we now have cash, of course, coming in that C is bringing in. Sometimes a question will ask you what will be in, say, and they'll pick a partner, say in A's capital account after partner C is admitted. And so the answer there would be what? 30,000 that they started with. In fact, why don't I go ahead and do a T account on that? This is partner, and I'm just going to pick one. I'm just going to do partner A. They started with what? They started with 30, right? And then we just credited them with what? 6,000 of the total 10,000 bonus that C is paying in. So if they asked me that, then the answer would be what? 36,000 is what partner, in this example, A is going to end up with. Question?
Yes. In Just out of, I know in the CPA exam, they're going to tell us which thing we're going to use, but just for the sake of argument, in the real world, do you happen to know which one is used, which method is used?
I think that it's up to the partnership. If there's already been if there's already been an agreement as to what they're going to bring in, right? Then we
Okay, I
can-
see. So this is something that would be specified in the agreement, and the general partners or whoever put it together would have made that decision already, right?
Correct. Yeah.
Okay,
If
got
there's
it.
agreement as to what they're going to bring in, then you decide between bonus and you decide between bonus or goodwill. If it's you're hired as the accountant to figure out what the guy has to bring in, that's obviously the exact method to end up with a certain percentage.
Okay, thank you.
Mhm. Yeah, and I just want to clarify the exam again, just to reiterate a little bit. If they ask us what to bring in, that means exact method. What the new partner has to bring in, that means exact. If they tell us what they're bringing in, then we click to what? Okay, it's either bonus or goodwill, and then the question needs to say. So that's why when you look at the next question, same facts, but now they say they're going to recognize goodwill. Okay. So, maybe it's not the same facts. I stand corrected. So since it's not the same facts, let's look at this. You could use the same facts for goodwill, but apparently they decided not to. So what happens in the example above? If C had invested $14,000 for a 1/3 interest in the resulting partnership, C would have received a bonus from, I
Bonus
see.
is going the other way.
Yeah, this is not goodwill yet. This is now the bonus is being paid to the new guy. Sorry, guys. Okay, the bonus is being paid to the new person, and they're paying $14,000 for that. Sometimes students say, well, why would they pay a new guy? Well, maybe this guy's bringing in some knowledge or line of business that the new partners want to try to get into or something, right? Okay. And so, the old partners want to try to get into, so they bring this person and they say, hey, we'll pay you a bonus. So if they're going to pay what? $14,000, right? And they're going to end up with a 1/3 interest of what will be worth $54,000 when you add that to the others capital accounts. That means that what? They're going to get an $18,000 share for what? Something that's worth $18,000 for only $14,000. So that $4,000 difference, right? The 18 minus the 4, right? 60% comes out of A's capital account and 40% comes out of B's capital account. So not terribly difficult stuff, guys. And I think once you kind of get used to these questions, actually kind of fun. Okay, now for goodwill, which is what I started to go into, again, they would have to tell us to use the goodwill, meaning they don't want us to use the bonus method. So now you come in and you take a look at the goodwill method, and now they're telling us that C is paying, and now it is the same facts as that other question for the bonus method. Now they're telling us that C is going to invest $35,000 for a 1/3 interest, and they are going to recognize goodwill. Well, for the goodwill method, you say, well, look, if the dude's paying $35,000 for a 1/3 interest, then the company is worth 3 times $35,000, or the partnership is worth 3 times $35,000. So that's $105,000. Yet what? The capital accounts of A and B plus what he brings in at 35 says that the tangible assets here are only worth 75,000. So we must have what? Goodwill. Okay, so we go ahead and we bring the goodwill onto the books. Okay, and the presumption here is that what? A and B are the ones that have generated that goodwill. So 60% goes to A in their profit sharing ratio capacities here. 40% goes to B. C gets whatever they contributed, and of course, we have the cash coming in. Okay. All right. So the trick is really figuring out what method they want us to use. I don't see that any of these are terribly difficult. And it's not that hard to tell which method to use, particularly when they call out bonus, they call out goodwill, which is what you see for these two questions here. So let's go ahead though, and I'll give you some chance to practice with these, okay? Oops, can't do it here, gotta do it here. Okay, let's go ahead and take a look at this one. Looks like a good chunk of us have had a chance, and looks like, you know, 78% of us got it right. The answer is B. I would think that this question is not terribly difficult, so we probably should have had a little better batting average, but let's go ahead and see how that should have been answered. So let's just take a look. And we have Eagle and Falk have partner balances of 45 and 25 respectively. They agreed to admit Rob. After the assets of the partnership are revalued, Rob will have a 25% interest in capital and profits for an investment of $30,000. So if it's 45,000 is what's sitting in Eagle, I guess, and 25,000 is sitting in Falk, and Rob is going to give what? 30,000. There will be a resulting equity of 100,000, of which Rob is going to get what percent?
25.
25%. So Rob's going to receive what value of 25,000 for 30,000. So Rob is paying a what? $5,000 bonus to the other two partners. Okay. Did I say $25,000 bonus? A $5,000 bonus. Okay. Okay, good. Let's try the Goodwill method. Same facts. And you may see this on your exam, by the way, guys, where they will go ahead. I remember taking the exam and all of a sudden there was 3 questions in a row, dealing with partnerships, same facts, and I just simply had to know how to use the different methods. I'll put the poll up. Okay. I'll give you a little more time. Looks like there's a couple folks. Okay, yeah, I think that's good. Let's go ahead and take a look. Let's assume everybody's tried this one. So, okay, most of us got it right, 80%. That's a pretty good percentage. Again, I'm not saying that these questions are terribly difficult, so you want to check your understanding on this stuff, guys. There's really not much reason to miss these questions, okay? These are easy points on the exam, but let's go ahead and take a look at this one together. And same facts as the previous problem, except now they want us to use Goodwill. So Rob's going to have to pay what? 30,000 for a 25% interest. And so that's equivalent to saying that that the partnership under the Goodwill method is actually worth 4 times the 30,000, right? Since he's only getting a 25% interest for this 30,000. Well, if the partnership is worth 120,000, and then we know from the previous that the actual equity that's been paid in is only 100,000, then there must be 20,000 of Goodwill here. Okay. Okay, good. Now, profit and loss distribution. And look, profit and loss distribution in a partnership is really based on the agreement. Whatever it is that the individuals have agreed, that's how they're going to share profit and losses. And so really, all we have to do if we get a question that asks how to distribute is follow the directions. I mean, there's no accounting rule or system that I can point to that talks about how you're supposed to do this, because it depends on what the partnership agreement is. But they do want to see, can you read a set of directions like something you might see in a partnership agreement, and then follow those directions. Okay, so let's just practice with that a little bit though, and let's look at this example down here where you have these partners A, B, and C, and they have capital balances of 30, 60, 90 respectively. The partnership profit for the year was 200,000. The partnership agreement provides for interest of 8% on ending capital balances, a salary of 10 to A, and a bonus of to C of 15% of partnership profits before any distribution ship to the partners. Set of directions. So they say the profit and loss ratios are 20 for A, 30 to B, and 50 to C. So what would be the distribution to each partner? Okay, so what happens? Well, follow directions. Total profit is what? 200,000, but C gets their bonus off the top. Then we have to sit here and do what? Then we have to sit here and pay the 8% of the capital balances. So if they tell me, for example, and I'm not gonna do all three of them, I'm gonna do the easy one, or at least it was easy to me when I looked at it. If partner B has 60,000 and partner B is supposed to get what? Supposed to get 50%, okay? Then we're going to go ahead and not 50%, but 30% right there to B, 30% to B. Then if I take 30% of 60,000, then they're going to get what this, I said it was easy. Now I'm having trouble with it for some reason.
Interest.
Huh?
The interest is 8%.
Oh, I'm sorry. Thank you. Providing 8% on ending capital balances. Thank you. I was wondering why that wasn't working for me. 8% of the capital balances, 8% of 60,000 is what? 4,800 that goes to B. And so on. 8% of 30,000 is 24, 8% of 90 is 72. I ended up doing them all anyway. Then you have to do what? You have to pay a salary. And so we are left with this 145,600 left to distribute, and we distribute that based on their respective capital sharing ratios. For example, 50%, right, of 145,000 is 72,800, and we're able to answer the question, what ended up being the distribution to each of the partners? Okay. So really just following directions. And I think that question is probably more complex than what you would expect to see in a problem like this one we're going to try right now, which is a little more straightforward, a little easier. So let's go ahead and more representative of what you'll see. So why don't we go ahead and relaunch the poll and take a look here. Okay, guys, there's no reason to rush through these. Okay, I'm giving you plenty of time to work on. I'm giving you at least 2 minutes, maybe a little more than that. So don't be in a hurry to choose something just to. Sometimes I feel like you're sitting there saying, well, just close your eyes and this will all be over in a minute. Okay, just, you have to sit there and kind of do the weightlifting here. Okay, let's go ahead and let's take a look at this one. Looks like we got a good chunk of participation here. And let's see, answer here is A. So we're split between A and B, it looks like, to a large extent. So not a real good result on this one. So let's go ahead and let's take a good look at this one. So we have what? We have these two partners, and they have what? 160,000 in young, I guess. And they have what? They have 100,000 in zinc. Maybe that might be part of the problem here. Maybe you're thinking they were asking about both of them. They only asked about who? Zinc here, right? Okay. So what happens? You start to take a look and they tell us that the partners received 10% interest on average capital balances and residual profit or losses distributed evenly, 50-50. So they tell us partnership profit before interest was 4,000. What amount should Zinc's capital count change for the year? Let's do both of them, okay? And so we take a look and it's what, 10% for each of them. So that means, let me write my 10%. That means, oh, that's all right. That means that Young is going to increase what? 16,000, and Zinc is going to increase 10,000. But then after you consider that that they've distributed 26,000, you have a $4,000 profit, but what? But we've distributed 26,000. So there's a remaining loss here now of what? A negative 22,000, of which they've decided to split evenly. And so that means that we're going to have to take 11,000 back from Young, 11,000 back from Zinc. And so if you look, Zinc's account did what? Decrease 5,000, while Young's increased 5,000. I mean, not 5,000, but 1,000. Okay. Okay, so again, get used to looking at questions like that, and practice following the directions. I think you'll be in pretty good shape with that. Okay. Withdrawal of a partner, and we're going to look at this. The problem that I have with the way they've illustrated this is I don't like examples with no numbers. I'm not sure what they're trying to do to me here by just giving me X's and percentages with no numbers. How the hell am I supposed to understand what's going on here? So I'm going to go ahead and I'm going to put some numbers on this. Okay, but let's look and notice we have the bonus method, we have the Goodwill method when we are exiting a partner. So maybe somebody's retiring and we're going to, take them out of the company now using either bonus or Goodwill. Okay. Now, they tell us that the difference between the balance of the withdrawn partner's capital account and the amount that person is paid is the amount of the bonus. And the bonus is allocated among the remaining partners' accounts in accordance there with the remaining profit and loss ratios. Okay. So I'm going to write some numbers in here, guys, and just go ahead and you should mark this up accordingly. I'm going to assume that this capital A has 40%, A partner has 40%, B partner has 40%. And so X partner now only has what? This 20% that's left. That totals up to 100%, right? Okay. And then I'm going to assume that the assets fair value is $100,000 greater than its book value. Because the first thing we have to do is write up any assets. Okay, so we'd have to revalue the assets at their fair value at this point, because essentially, if a partner leaves a partnership, you essentially have a new partnership at the end of that. So you're going to have to do an asset adjustment, and I'm going to assume that the 100,000 is the amount they need to write up. When I say assume, I made that up for this example, just like I made up the 40 and the 40 and the 20. So what happens? 40% of that goes to partner A. 40% of that goes to partner B, and 20,000 of that will go to partner X. With me so far? So we just wrote up the assets, okay? Now, when we distribute, okay, and I'm going to assume here, assume that if this was partner X's capital account, okay, I'm just making this up, guys. Assume they had 30,000 in there before we started to do any of this. We just did what? We just credited it for 20, didn't we? Okay. And assume that they're going to pay a $10,000 bonus. They're going to pay this guy a $10,000 bonus as he's leaving. It's his retirement gift. He's going to get a $10,000 bonus. Bonus to X. Okay, so let me ask you a question. How much do you think X should get here? How much money do you think X should get here?
Sounds like 60,000.
Good. X is going to get 60,000, right? Because he's got 50 sitting there and they're going to give him a $10,000 bonus. So X is going to get 60,000. Good. So I know I have to pay out cash of 60,000, don't I? Okay. Now, the tricky part that we would do here is of the remaining amounts of the remaining partners, the partners that are staying, what? 40% divided by 80% is essentially 1/2, isn't it? 40% divided by 80% is 1/2. So if we take that times the 10,000, that means that 5,000 is going to come out of A's capital account. 5,000 is going to come out of B's capital account. And of course, we're going to cash out X. X got what? 50,000 in there. And then of course, he's got the $10,000 bonus. He got more than what he put in, right? Or than what he has in there. Okay. Okay, good. Now,
So if he had not gotten a bonus, would it just be X capital 50,000 cash, 50,000?
If you hadn't gotten a bonus, it would be X capital 50,000, cash 50,000, because they're not paying him any more than what he has in the account. Yeah.
But it says journal entry to pay off withdrawing partner, so that's what's confusing to me.
Well, this was a bonus. They were saying there was a bonus.
Yeah, okay. Oh, okay, it's because there was a bonus. Okay, I'm sorry, I
Yeah.
just didn't,
Yeah, if there was no bonus, I guess it'd be 50,000, but again, sometimes students say, where do these numbers come from? They came from the twisted mind of John Lord. I mean, I just sat there and put some numbers to illustrate how you would do this. And so I just assumed a $10,000 bonus.
I'm sorry.
Yeah.
Now I see where you're coming from.
No, it's a little confusing. I mean, Becker should have put some numbers in here. I don't know what the hell they're doing. And it's not like this example just came in here yesterday. This example has been in here forever with no example, with no numbers. I don't get it. Okay, all right. Now let's go ahead and let's see what happens with the Goodwill method. Okay, and with the Goodwill method now, we're going to go ahead and we're going to assume the same percentages. Okay, but now, and the assets are 100,000 more. Okay, so we're writing the assets up, and it's going to be, you know, you're not having deja vu. It's the same exact numbers that we used a minute ago. Okay, and so now we're sitting there, and we are going to use the Goodwill method. So right now, if we look at, and again, I'm going to assume that X capital, assume that X capital had what? 30,000. We just sat there and credited it 20. So X has what? 50,000 of a company that is worth, he has 50,000 in his capital account, and he owns 20%. So they're essentially saying that the book value of the company right now is what? Am I doing my math right? 50,000 divided by 0.2 is 250,000.
Yes.
Okay. But let's say they told the dude, look, we're going to kick you out. I know you got 50,000 in your account, but we're going to give you 60,000. They're going to give him 10,000 more. So now that's equivalent to saying that what? That 60,000 is, the company is worth 60,000, the 20%. So that's like saying that the company is what? Got 300,000 of value, right? If they're going to kick them out 60,000 under the Goodwill method. So if that's the case, if we had said book value is 250, but we're really saying that the market value of this whole thing is 300,000 because we're going to give them 60,000 to get them out. That means that what? That means that we have goodwill of 50,000, don't we? Okay. So they debit the goodwill, 50,000. They go ahead and again, they use the respective capital that's left of we go ahead and we take the percentages. We don't have to use the respective that's left. We use the percentages for each one of them for the goodwill, which means that we're going to credit the partner A for 20,000. We're going to credit partner B for 20,000, and we're going to credit partner X for what? 10,000. When we do that, now their capital account has a total of what? 60,000 sitting in there. And so we go ahead and we cash them out. We credit the cash 60,000. We debit their capital account 60,000 and they're paid out. Okay. Okay, so I just don't see how you would have got that with no numbers. So that's how you would do that. Okay. Okay, good. Now, liquidation of a partnership. Okay, and with the liquidation of a partnership, it's important to note that creditors get paid first. But what you're going to have to first do, hello to liquidate, right, is convert any non-cash assets to cash, distribute that to the partners, and then start paying out creditors and paying partners the different amounts that they are owed. Okay, so just to quickly look here, guys, they give us this example and they go through all kinds of different scenarios. But let's just look at assumption one, and I think I'm going to let you read through the other ones as you go through. But they tell us that they have non-cash assets with a book value of 75. They sell it for 125. So how much gain is that? 50,000. Good. And then they go ahead and they distribute that gain according to the respective amounts in each one's account, right? And so 25,000 goes to A, 15,000 to B, 10,000 to C. And so now we have what? We have the amount that is attributable to each person, right? But then we have to go ahead and we have to pay liabilities. So we pay the liabilities 25,000. So now we have what? Now we have 120,000 left, and then we have to pay. And the question said that A has a loan that's supposed to be paid back, and another 5,000 was supposed to be paid back to C. So we distribute those amounts. So now we're left with 100,000, and again we distribute that 100,000 relative to each of their partnerships. So again, the liquidation process is very similar to what we talked about for distribution of profit and losses. You just have to follow directions, but it's important to note that you have to turn all the assets into cash, you pay any creditors, and then you pay any amounts that are owed to respective partners, because maybe they loan money to the partnership or whatever, there's some amount outstanding to them, and then you distribute whatever's left. Okay.
I'm a little confused about the 15 and the 5 that were loans that were being paid back to A and C. Where did they go as far as the partner's capital account? They don't go directly to it.
Well, they were saying how much cash is left, right? So
I'm just about, is that an advance from the partner to the partnership, or is that an advance from the partnership to the partner? The directionality was what confused me.
Well, there's 25,000 that's owed to these guys, and then 15,000, it's saying advance. Payment of partners' advances, because it's not subtracting it from their capital accounts, right? It's subtracting.
Okay, so they lent
total
to the partnership. So they lent to the partnership. They are
Right.
an internal creditor, correct? So they are a creditor of the partnership.
Correct, yeah, because it came
Okay,
off
that's-
of, the 20,000 came off of the available cash, right? So we were saying, hey, these guys got to, that's a liability.
Okay, so
Liabilities,
they're
partners.
paying the external creditors first, then they're paying those partners that lent to the partnership, correct?
Correct,
Okay, that's what I was confused about because of the word
Right.
advance.
right. Yeah, advance, that's why I had to stop and look at it too. Advance sounds like they advance to the partnership, the partners advance to the partnership. AMC advanced to the partnership. So after they get paid, there's 100,000 left, and then it distributes based on the partnership shares.
So still, that leaves the question, if they're paying cash back to the partners that had lent them money originally, why doesn't it hit the partner's capital account as a return of capital?
Well, I don't know that it was being asked as, is it a return of capital here? I mean,
I think typically if a partner makes a loan to a partnership, that is considered additional funds that are being put in, and that is separate from the capital account. Matthew, that's what I've seen. Does that make any sense?
So it kind of goes into their percentage of ownership, essentially.
Well, if it's structured that way, but if it's not structured that way and it's a straight loan, then it's like you've come out of your pocket a little bit more. You have not bought more of the partnership, but you have said, okay, partnership, you can use my $15,000, but you better pay me back before you liquidate. So it's a loan as opposed to a purchase of additional share, because if you purchase additional share, you're diluting the other partner's ownership. They might not like that.
That makes sense. I get it. So it's a completely separate liability.
Yeah. And that's why once I understood which direction the money was going, then it made sense to me.
Got you. Thanks.
Yeah, I mean, to me, it was this says liabilities, but anyway, okay. Any question? Okay, good. So that's it for chapter 2. So let's go ahead and let's take a quick break. Why don't we come back at 5 till, so we can at least start on chapter 3 tonight, okay? I'm going to go ahead and pause. Matthew, I guess you're the designated reminder.
Got you.
The recording. Okay. All right, good. So what we're going to do is jump into chapter 3. And remember, we had our whole discussion of the income statement in chapter 1, and then we were still sort of hovering around revenue recognition to a large extent as we talked through some of the chapter 2 topics. Now we're finally going to start to come in and start to pay some attention to the balance sheet. Okay, so if you look at chapter 3, we're going to be dealing with the asset side of the balance sheet, and we were literally going to walk through the asset side of the balance sheet, starting with the most current assets. You can see cash being listed there, obviously, is a current asset, working capital discussion. And then we will come down to, more of our longer term assets, our non-monetary transactions and tangibles, dealing with impairment. Okay. Now, when you look at cash and cash equivalents, okay, and that's probably going to be about 5 points on the exam. Examiner is going to ask you something about, whether cash is restricted or not restricted, how it's treated, etc. About 5 points. Trade account receivables, 10 points on the exam. And it's not only receivables, it's also the allowance against the accounts receivable, and that's probably the part that contributes more towards those 10 points. They expect you to understand your allowance accounting. Inventory is 10 points, and we're going to see, probably not tonight, it's probably going to be next time, but we're going to see that they're going to expect us to know the different inventory valuation methods, LIFO, FIFO, weighted average, etc. Okay. Property, plant, and equipment, and the depreciation. I wish I could put a 10 next to this, because this is pretty easy, but the examiners know that, and so they're probably going to cover you with 5 points there. Non-monetary transactions, a little tougher area, not a lot of point value there, probably about 5 points. Intangible probably about 5 points as they talk about intangible assets. And then impairment probably won't get too far off into that. You could probably expect about a 2-point area there. So you see a fair number of points here. The chapter 3 material, guys, I can tell you is pretty straightforward, probably more straightforward than some of the things we've dealt with up until now. I'd much rather be dealing with the stuff from this chapter than say trying to figure out, you know, some of those things that we were looking at on the cash basis and whatnot just a few minutes ago. Okay. All right. So let's just come over and they start out the discussion here about working capital. Okay. Well, actually, this is going to start out the discussion of cash and cash equivalents. Excuse me. Working capital is basically current assets minus current liabilities. So I guess they're not going to talk about that as much here, but they do want us to understand cash and cash equivalents. Okay. Now, example of cash, I think is pretty easy. Coins and currency, checking, savings account, money market accounts. All of these are considered cash. Now you come over and we say deposits held as compensating balances against borrowing with the lending institution has not legally restricted. So what does that mean? You've got, you know, 100,000 that you borrowed, but they tell you, well, look, we'll give you deal on the interest rate if you don't borrow the full 20,000, right? But you do borrow more than the 20,000. They can't legally restrict you from that. Well, that's still considered cash. Contrast that with what they're saying below. If you have what? Legally signed an agreement that you will not withdraw the full 100,000, then that cash is not considered cash. It is not considered cash. And so you would have to distinguish that as a deposit that you are legally restricted. And of course, you would probably from withdrawing, and you would probably have to footnote that. Okay. Now, other things here that are cash equivalents. Other things that are cash equivalents. Now, let's just look at cash equivalents right here, okay? And they start talking about negotiable paper, bank checks, money orders, commercial paper, and treasury bills and certificate of deposits having an original maturity of 90 days or less, okay? Flashcard that's all the same thing. That 90 days or less also applies to the commercial paper and the treasury bills, and its original maturity to purchaser. Original maturity to the purchaser of 90 days or less. Okay. Now, what I want you to do is just do a little example down here. Okay. Let's use a little example down here. Let's say we have a T-bill. And let's say it's a 1-year T-bill. And say company purchases the T-bill on 1/1/2021, and it'll mature. So that's when they purchase it. I guess I'll write purchase here. Why didn't I write it next to the date? So they purchase it on 1/1/2021, and it matures on 1/1/2022. Okay, now that is that was how that thing would look. They purchase it. Now, let's say that's company X that purchases it on 1/1 and it matures. Company Y same 1-year T-bill, but company Y purchases it on 12/1/2021. And it, of course, since it's the same T-bill, it will mature on 1/1/2022. Okay, so same dates that it matures on the same date. Now, the question is, I'm going to ask you a series of questions about these. Number one, is it a current asset to company A and company Y? Is it a current asset at, and I should probably give you the date, right? At 12/31. At 12/31/2021, is it a current asset to company X?
Yes.
Yes.
Yes, good. Current asset because it's going to mature the next day, right? Okay. How about company Y?
Yes.
This is company Y over here, guys. Okay, good. All right, good, excellent. How about cash equivalent? Is it a cash equivalent to company X?
No.
No,
No.
No, because it didn't have an original maturity to them, the purchaser, of 90 days, right? How about company Y?
Yeah.
yes,
Yes.
Good. The original maturity to the purchaser, and the book should have been more careful to call that out. It's the maturity to the purchaser was less than 90 days, the original maturity to the purchaser. Good. Excellent. Okay. All right. So make sure you flashcard that and keep in the back of your mind that that's listed as a cash equivalent. And when we prepare the statement of cash flows and we look at the change in cash for the period, it's the change in cash and cash equivalents for the period that we'll be reconciling, whether it's by operating, investing, or financing activities. Okay, good. Now, they tell us here that cash can be restricted or unrestricted. Okay. Unrestricted cash, always and forever, guys, is a current asset. You don't have to ask yourself anything else. If the cash is unrestricted, it's going to be a current asset. Okay, you can flashcard that. Restricted cash, okay, cash that has been set aside for a specific purpose, okay. Unrestricted cash could be current or non-current. Do they say that here somewhere? Okay, well, they don't come right out and say it. So just go ahead and, just to be parallel here, put restricted could be current or what? Non-current. Okay, could be current or non-current. That says current or non-current. Okay. And what really depends on the restriction. If the restriction is associated with a current asset or a current liability, you're setting cash aside to buy inventory, then that is going to be considered, that cash to be considered a current asset. If you are setting it aside for a non-current asset, non-current liability, so now you're saving cash to buy equipment, then that cash would be considered non-current. So when you really look at whether we're calling an asset current or non-current, it has a lot to do with the intent of the company, doesn't it? What do they plan to use it for? Not something that we're getting to in this chapter, but again, it's worth keeping in the back of your mind when we get into stockholders' equity later. We would probably also appropriate the retained earnings for cash that we're restricting for some purpose. Okay. Okay, good. Come over and let's take a look at, we don't have to go through restrictions, okay? Items to include in cash balance. Now, guys, this thing is a little irritating, but what I like about it, and the reason I'm going to go through it with you, is you will probably see this in other areas, not just related to cash, the way they're doing here, in which they're going to give you a timing exercise so that you know whether or not to include something in the balance. So you see this a fair amount on the CPA exam, so it's worth it for us to look. And so they tell us that before they have made any adjustments at December 31st, they had $160,000 of cash. Now they say a $5,000 check payable to Smith dated January 2, year 8 was not included in the December 31st, year 7 checkbook balance. Should it have been?
No.
No, and so we would have to get used to what? In old days when you took the exam in paper, the advice would be I-beam that, so you don't keep looking at that. Get rid of that. That's something that should be ignored, right? Okay. Then they say they have a $3,500 check payable to Smith deposited on December 22nd and included in the December 31st checkbook balance, which was returned non-sufficient funds. That means it bounced. The check was redeposited but didn't clear until what? Until January 7th of year 8. So was that cash at the end of year 7?
No,
Huh?
no,
Was not. We did not have future economic benefit in that check on that date because it didn't have the funds, right? Okay. So notice for that NSF check, they do what? They're going to back it out of that unadjusted cash balance. Then they say that there was a $25,000 check payable to a supplier drawn on Smith's account. That means they wrote the check, right? That was dated and recorded December 31st, but didn't mail until year 8. Well, if that's the case, then it should be what? Should be included in the year 7 cash balance. Okay. Look, when I started this question, I said it was annoying. I understand that it's annoying, but by the same token, I do want you to be aware that these timing questions like this are frequent on the exam. And so you got to get used to kind of reading through the way they word things and this kind of stuff. Okay. All right. Bank reconciliation. And the key word here is simple. Okay. Now I know as accountants, you balance your checkbook to the penny every month. Okay. Haha, like anybody does that anymore now with online banking, right? But the examiners will expect you to be able to balance a checkbook. Okay, so let's just go ahead and let's take a look at, and I'm not going to go through all the different definitions because I think you know this, but let's just practice a little bit with how we would balance this. And the way I like to look at these is I say to myself, what did the bank know? What did the company know? Okay, and if the bank knows something that the company doesn't, I'm going to have to adjust the company's cash balance. If there's something that the bank doesn't know that the company knows, I'll have to adjust the bank balance. And these things, once we figure them all out, should reconcile. So the company's records show a cash balance of $12,650. And the bank shows a cash balance of $10,050. The bank has a service charge and there was an NSF check. And then there are deposits in transit, which is something the company would know about that the bank doesn't. So what do? They go ahead and they start with the balance per books. And then they start adjusting it for these things that what? That the bank knew about that the company did not, the NSF check and the service charge. And so the adjusted cash balance here, the correct cash balance is going to be this $12,550, right? Okay. Then what happens? Then they go ahead and they start with what the bank balance was, and now they start adjusting it for things that the that the company knew about that the bank did not. So we go ahead and they pick up that deposit in transit. They subtract out the outstanding check and this thing balances. Everybody can go home. Okay, I don't mean we can go home. Everyone can go home once we balance to the bank. I mean, this is not the auditing course, guys, but from an internal control standpoint, cash got to tie every day, right? Before anyone goes home. So, okay, good. Don't worry about 4-column proof of cash. That's not something that we're going to have to get into here. Okay. Okay, good. So let's just go ahead and let's take a look at this first question from chapter 3 now and see if we can handle what is the question on cash equivalents here. Okay, let's go ahead and take a look at this one. And I'm going to go ahead and start from the bottom. What do you think of this one, Jason? 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 Jason?
Sorry, what was that?
What did you get for this one?
I got 1.9 mil.
1.9 million?
Yes.
Okay. All right. How about Shannon? What did you think?
D, 1.9 million.
Okay. Jinsu, what did you think?
I got C, 1.4 million.
Okay. Good. What do you think, Gautam?
C.
See?
Yep.
Yep. Cynthia?
B.
B. Okay. How about Cornelius?
C.
C. Okay. What do you think, Andrew?
I was still working through it. I honestly, I just got off the phone with BDO.
Okay. What did they think? No. Okay.
They offered me an internship.
Oh, okay. Well, congratulations. Say hi to my buddy Rich Gunn over there. Okay, good. That's good. All right, so let's go ahead and take a look, and I'm gonna stop just because I don't want to spend too much more time. And some folks I can see their camera is on, but let's just go ahead and take a look at how we did on that. Okay, so that was sort of reflected in what we saw, that most of us got it right. 70% of us got it right. Okay, so that's good. Okay, and so let's just take a look though, because we did get some variations in the answers. So we want to know which is cash and cash equivalent. So cash in a money market account is a cash equivalent, right? It's cash. Cash in a checking account, cash in a money market account is, okay. US Treasury bill that was what? Purchased 12/1 and is going to mature 2/28 year 3, barely made it in, even in a leap year, it would make it into the 90-day criteria, wouldn't it? Original maturity to the purchaser of 90 days. So I'm going to go ahead and I'm going to pick up that 800,000. This 500,000, they did what? They purchased it in year 1, and it's not going to mature, I mean, in year 2, and it's not going to mature until year 3. This may be the very same, well, I guess not, because they call this one a bill and they call this one a bond, but whatever. It's not a bond anyway. If it was, I guess it could be a note or a bond. Anyway, I'm not going to start to get into correcting this question, but basically what they're sitting there and they're saying that they bought it and they've held it for more than a year. So that is not a cash equivalent, right? Okay. Okay, good. They're all going to be current assets, but it's not a cash equivalent. So when we add these up, we get what, 1.4? Okay. Okay, good. Let's go ahead and let's take a look at receivables. Now, again, as I told you, account receivable and the related allowance, which is where we're going to spend most of our time, is heavily tested on the CPA exam. Now, we talk about it here as it relates to accounts receivable because they may be asking us to figure out the accounts receivable. And I have some students that say, oh, I'm just going to use T accounts for this. Not on the CPA exam. The CPA, God made T accounts to tell you what the ending balance was in any particular account. Okay, if on the CPA exam, they don't always ask you the ending balance. They'll ask you what was the adds to the account, what was the sales for the period, what was the collections for the period. And you can't sit there and use T accounts to work backwards. You want to use this blank account analysis format. So anytime you get a question, and if they ask you the ending balance, that's kind of a generous question. You can still set it up like this. That'll mean they have to give you the beginning. They have to give you the adds, whatever it was, the subtracts, whatever it was, for you to be able to calculate then the ending balance. But questions on the CPA exam aren't that friendly. Usually they'll give you the ending balance. They may give you what was subtracted from the account. They may give you the beginning balance, and then you've got to figure out what was the add for the period. Okay, so you want to get used to using this. Okay, now we are going to take a look at it from the context of account receivable here. And what I'm going to do is I'm going to go ahead and tee up my accounts receivable right next to it. So you see how this relates to T accounts, but on the exam, you need to be using this format to answer questions, okay? Now, I'm gonna go ahead and also do general journal entries and then go ahead and post them to this account receivable T account, okay? So we have, and I'm not gonna do a journal entry, obviously, for the beginning balance, but the beginning balance is 90,000. I'm just gonna write that in, okay? Then what happens? I don't like where I'm writing that. stuff in the way there. I'm gonna put it over here, accounts receivable. And it has a beginning balance of 90,000. Okay, then they have credit sales of 800,000. So what am I gonna do? I'm gonna debit accounts receivable, 800,000, and credit what? Credit sales, what?
Same revenue.
Say that again?
I said revenue. Or sales.
Okay. Okay, so I credit sales for 800,000, okay? Then, so sales add to the account receivable, right? Then they tell me that I had cash collections of 810. So if I have cash collections, I'm obviously going to do what? Debit cash, 810. And I'm going to credit the accounts receivable, 810, because if I collect on an account receivable, that brings the account balance down. Then they tell me that I had converted some accounts receivable to note receivable. Okay, well, I guess the examiner's got to think of something to test us on. So I would debit note receivable for what? 7,000, and credit accounts receivable for 7,000. And then they had some accounts receivable written off. So if I write off an account receivable, I debit the allowance for doubtful accounts for 23,000, right? And credit the account receivable for 23,000. Okay. And then I should come up with this ending balance here was 50,000. Now I'm just showing you the relation to the T accounts, but again, don't try to use T accounts for a question like this. They're not going to ask you the ending balance, guys. They're going to ask you what was the sales, and you can't sit there and come up with the sales from T accounts. You'd have to sit there. And the way I do these is I do sub accounts. So what I would do is I would say, well, look, if they had an ending balance and say that's given the problem of 850, and these were the subtracts, right? These are the subtracts. Then if I have 50 and I have subtracts of 840, I must have had what? 890 before I added anything. And if the beginning balance was 90, then I do a little side calculation, 890 minus the 90,000 that was the beginning balance means that the sales were what? The ads were 800,000, okay? You've got to get used to thinking through questions like that, guys. Get used to doing them like that. Don't go with whatever you've been doing before. On CPA exam questions, you're going to have to get used to using this subtotal, okay? And taking the information as it's given, figuring out, well, what was the subtotal? And at a beginning balance of 90, what would be the add? Let's say they asked me what was the subtracts, okay? Well, if that's the case, then I would take the beginning balance. They'd have to give me the adds. It's 890. How did they what? How did they end up with 50? Well, they had to do what? Again, I do my little side calculation, 890 minus the 840, minus the 50,000 of the ending balance means they had 840 of subtracts. And then they could even tell me these parts and I'd have to back into the 810. But the account analysis format allows you to systematically and quickly do these calculations. And you want to be consistent in how you do them. Because if you do it different when they ask you the beginning balance versus how you do it when they do the ending versus what if they ask me to add, what if they ask me to subtract, you're like the tennis player that's running back and forth across the court and your opponent keeps serving the ball to the other side. If you sit there and you have what? You have a consistent footwork, you can go left to right, right? And you don't get all worn out and waste a bunch of time trying to deal with each question as they come along. Okay. Very important, guys, to use that account analysis format to your advantage. Okay, good. Let's talk about valuation of accounts receivable when there's a discount. Okay, and this is really introductory type stuff, but the exam does like to ask this. Okay, so if you see 210 net 30, that means there's a 2% discount if we pay in 10 days. Otherwise, we have to pay the entire amount in 30 days. If it says 5 net 30, then it's a 5% discount. 110 net 45 means what? You get a 1% discount. You pay in 10 days. Otherwise, you have to pay the whole amount in 45 days. I think you know that. Okay. Now, when we record receivables with discounts on them, we can record that using the gross method or the net method. Okay, let's just come over and let's look at this example here. Okay, and with the gross method, you just assume that you're not going to take the discount. So you debit the receivable gross, you credit the sales gross. Now, if you believe, I don't say that you're going to take the discount, your customer is going to take the discount. If you believe that your customer is going to take the discount, if you believe that your customer is not going to take the discount, you use gross. If they take the discount, then you're going to receive what? 2,000 less cash. So you debit cash 98, you debit sales discounts taken, and you credit the account receivable. Now, if that's the case, when I report sales, I'll have sales, what? And the sales were 100,000 less the discount, which is 2,000, which means that I would have net sales here of 98,000, right? Okay. Now, if I believe that my customer was not going to take the discount and they don't take the discount, that's very easy. Then, of course, I simply debit the cash and I credit the account receivable. Okay. Now, if I think the customer is going to take the discount, then I'm going to use the net method. Under the net method, I book the receivable net of the discount. If they don't take the discount, fine, I simply debit the cash, I credit the accounts receivable. If I didn't think I thought they were going to take the discount and they do not, then I will go ahead and I will debit the cash, 100,000. I liquidate the receivable and I credit this account called sales discounts not taken, which essentially would be added to sales so that my sales reflect the amount of cash that I actually collected. Sometimes students say, well, why don't you just credit sales? Well, if I just credited sales, I'd get the right answer, but I would lose visibility as to how often my customer takes my discount. And if they're not taking it very much, maybe I need to make that discount a little better, right? So that might be why a company would use this account sales discount not taken, but it's going to add to my sales. Okay.
Would I do it by customer, like have a mix of those? Because I would imagine some customers regularly take discounts and some don't in any company. Could they mix the methods or not? Is that just not done? You have to pick one and use it for all your customers.
Well, if I have a customer that takes the discount here, I would have sales discounts taken, right? Yeah, I guess if we're doing it here, I mean, I would do it this way because I'd want to know whether they're taking the discount or not myself. So I'm not really quite comfortable with this net method because I would agree with you. You lose visibility under the net method of customers, whether or not they're taking the discount here. I mean, I guess what you're seeing here is, those customers that didn't take the discount and how frequently that happened. But I don't know. I find this method cleaner, to be honest with you, the gross method, because I'd want to know this.
Okay. All right. Thanks.
Yeah, but they're mirror images of each other. Yeah, but I think the company's gonna be consistent in, I don't think they're gonna use gross method for some and net method for others. They're gonna be consistent in how they do it. I think what they're saying to you under the net method is everybody takes your discount. Okay, so maybe you would use it then. Okay, all right, let's take a look at trade discounts, okay? And I like to, use the analogy of Macy's here. Have you ever gone shopping at Macy's and you go and it says 40% discount? And then, I don't know, they used to do this. Then they put another little flag on top of that 40% discount that says another 10% taken at the register. And you start thinking to yourself, oh boy, 50% off. And they don't give you 50% off. They do what? They take 40% off the original price, and then they take what? A 10% discount off of the already discounted price. Well, CPA exam does the same thing. They'll give you the discount in two tranches, trying to trick you into adding that together as a 50% when you have to take the first discount and then the second discount on the already discounted price. Okay, so that's what happens here. They call out that they're going to sell 100,000 worth of coats, and it's a 40% discount. Okay, so there's that 40% discount. So after the discount, it's 60,000. And then that second 10% discount comes off of the already discounted price. So the accounts receivable is 54,000, right? Okay. All right, good. Let's take a look. And I've had students ask me, why do they break the discounts into two? Well, that's the whole point, is to trick you, right? Okay. Now you come over and we start talking about uncollectible receivables. And again, guys, that 10 points I think is going to be more here than elsewhere. Direct write-off is not GAAP. So I'm going to put a big no next to this journal entry because they show you that. And this is bad. If a company did this, you would have to fix this. This is not how you deal with bad debt expense. You don't wait till the customer comes in and tells you they can't collect. What the accounting standards say is, look, it is inevitable that you are not going to be able to collect some of your receivables. So what we are going to require you to do is analyze your receivable and see how much you think you're not going to collect and create an allowance for that, even though the borrower has not yet come in and told you they can't pay, because it's inevitable that some folks, for whatever reason, won't be able to pay. Okay, so what we're going to look at is a couple of different ways of calculating what should go into the allowance. And one is to take the percentage of account receivable at year end, which we are calling the balance sheet approach, was the only approach available to us anymore. And so with the percentage of accounts receivable method, the balance sheet approach, they look here and they say, well, you've got 80,000 and your experience is that 2% is not collectible. So that means you need 1,600 in the allowance. But if you had already put into the allowance in previous periods and there's say $1,000 sitting there, then to get up to 1,600 in the allowance, you just need an additional $600. You would debit bad debt expense 600, credit the allowance for $600. Okay, now you could also be more sophisticated and you could age the receivable. And by the way, guys, again, this is another version of the balance sheet approach. Companies can be as sophisticated as they like in doing this. I was doing an audit where Congress wanted us to look to see how good of a job banks were doing in putting amounts in their allowance for loan loss. And Congress was interested in that because they were worried about exposure to the FDIC insurance, right? And the banks that we were looking at had a very sophisticated process as how they saw that loans migrated to bad debt, and they were using those numbers for the amounts that they were deciding to put in the allowance. The problem that I had is then they were kind of putting their thumb on the scale and putting a little extra into the allowance in good years, so that if the things went bad later, they had a little cushion in there, and that I did not like. But they were very sophisticated in how they did this. So an aging is a little more sophisticated, right? And notice the more overdue a receivable is, the more we put into the allowance. Now look, if after doing this, you so happen to come up with the same, consideration that you needed 1,600 in the allowance and you already had 1,000 in there, then we would debit the bad debt expense 600 to credit the allowance. So, what method you use obviously probably wouldn't yield the same number, but once you come up with that number, you adjust the allowance to put in there what you need. Okay. Now, when you look at this next example, guys, and I'm going to come back to these write-offs and whatnot, because I want to show you this example, and then I'm going to go back and show you a couple of journal entries, but I'm going to use this that are on that page I just skipped, but I'm going to use this example for journal entries, okay? And so just so you can see how the blank account analysis format works for the allowance. But like I did for the account receivable, I'm going to tee up the allowance over here so you can see how the blank account analysis format works for the allowance and how it connects up to T accounts. And I'm going to do the debits and credits in general journal form as well. I always say that, and I start with the thing where I'm not making a journal entry, which is the balance in the allowance is $20,000, right? Now, in this question, this example, they take a percentage of sales as their sales are made, but the percentage of sales method is not allowed anymore. Even if you put amounts in based on your sales, you still, the way they do in this problem, have to make an adjustment based on your aging, your percentage of your account receivable. You must use the balance sheet approach. So you always have to adjust the receivable at the end. It used to drive me nuts that people would think that it was okay to just do the percentage of sales. And I'm like, that's ridiculous. If you just did percentage of sales, what if a company had collected all of their account receivable by the end of the year? You wouldn't need any amount in the allowance if they had collected everything by the end of the year, if the accounts receivable was zero. And what would happen if there was, I don't know, a pandemic that all of a sudden hit and their historical amounts that they collected on their sales wasn't relevant anymore? You'd want to look at current events and make an adjustment to the allowance based on what's happened by the end of the year. And I used to make that argument, and people, well, back and forth. And then FASB finally agreed with me and said, no more percentage of sales method. You must always make an adjustment to the accounts receivable at year end, even if you're putting amounts in as you make your sales. Okay, so that's what this question does. It sits here and it says, well, look, my experience tells me that 2% of my credit sales will be uncollectible. So as I make the sale, I am going to go ahead and I'm going to debit my bad debt expense for $14,000. And I'm going to credit the allowance. And they're doing that as they make the sales. Now, that's not going to get them off the hook to do the year-end analysis of the account receivable, but they could do that during the year. So I go ahead, I put 14,000 in the allowance. And just for fun, why don't we just go ahead and tee up the bad debt expense too for 14,000. Okay. All right, good. Then what? Then they tell us they have write-offs. Okay, well, if you have a write-off, and I think they show me the journal entry down here, so I don't have to write it. The write-off, they debit the account receivable for 12.5. They debit the allowance for 12.5. They credit the account receivable. Okay, so I debit the allowance for 12.5, and I'm not going to tee up account receivable. It's not They don't even give me enough information to be able to tee up account receivable. And so it's 12.5. So then they go ahead and they determine the desired balance is 20,500. That desired balance would be based on a year-end analysis. And I think in this example, it's per aging. So even though they put amounts during the year, you still got to go and do the balance sheet approach, year-end analysis of what's in the receivable account to decide what you need in the allowance. And they decided at this point that they need 20,500. Now, if you look right now, they have what? 21.5. So they have too much, don't they? They have too much in the allowance. So it's kind of like you ever go to Starbucks and they fill that, you say, give me room for cream, and they don't listen to you and they fill it to the top. So what do? You just dump a little bit out, don't you? So you have the room you need. Okay, so we got too much in the allowance. We're just going to go ahead and we're going to dump a little bit out. So we go ahead and we debit the allowance for 1,000. We credit the bad debt expense for 1,000. Okay. When we credit the bad debt expense for 1,000, now it what? Now it shows 13,000, right? Which is the correct amount. Okay. We made that adjustment. So we debited the allowance. Just to make sure I have this complete. And now there's the amount that we want in there, which is what? 20,500. Okay. Got to know this, guys. Got to know all of this process. And now going back, because I promised I'd go back to a couple of these journal entries up here. You also have to know how to make a journal entry for subsequent collection of a receivable that was written off. So, and again, this is not how you do things. We don't do the direct write-off method. Okay, the allowance method, first you reestablish the receivable. You debit the account receivable, you credit the allowance, and then since that person is paying you, you debit the cash and you credit the account receivable. Those are the journal entries for the recovery. Now, sometimes students say to me, well, wait a minute, now there's too much in the allowance because we put that amount back in the allowance. No, we put that amount in the allowance for people who really don't pay us based on our experience, not for people that maybe have a couple of rocky innings and then later on find some money and pay us. This is for people who really won't pay us. So we put that back in the allowance, waiting for those individuals, and we go ahead and we recognize the cash, we credit the receivable. Okay, so flashcard that, flashcard the entry for setting up the bad debt expense, flashcard the entry for the write-off, flashcard the entry for reestablishing the receivable. I need you to know that. I need you to know how to set up the allowance. I need you to know how to do the write-off. I need you to know how to do the journal entry for the recovery. Question? 10 points, guys. 10 points. Okay. All right. Now, let's talk about this idea of pledging accounts receivable. Okay. What happens here? Well, probably a company is getting a little tight on their cash. And so they sit there and say, you know what? We're going to go ahead and basically sell these receivables and get some money from them. Okay. So when we have pledging, okay, we basically pledge the receivables and we pledge it as a loan, as collateral for a loan. If that's the case, then we leave the receivable on the books, okay, and we do not remove it. And we also would have to footnote that we have pledged the receivable. There's like a lien on the receivables. Now, we could factor the receivable, okay? And we could factor without recourse or with recourse, okay? Now, without recourse is going to be a sale. With recourse could be a sale or borrowing / pledging. Okay, now without recourse means it is a sale and the sale is final. Okay, and the factor, the person buying the receivable, assumes the risk of loss. Okay, so go ahead and flashcard that. The sale is final. And there's no recourse against the seller. And let's just go ahead and take a look. And they give us this journal entry without recourse. And it's also a journal entry without what? Numbers. So I'm going to go ahead and put some numbers on this because I don't know where I come from. I like numbers on my journal entries. Okay. So what happens? I'm going to say that company factors $1,200 of AR without recourse. Factor without recourse, sorry guys, without recourse for $1,100. Now, why are they only going to get $1,100 if the account receivable is if the account receivable is 12?
It's essentially a loan. There's some kind of fee associated.
Yeah, well, it's not a loan because it's without recourse, but the factor, you're right, wants to make some money off of this, right? Okay, so they want to make $100. And then the factor holds that a margin of 100. Now, it's not a loan, Matthew, because if they can't collect on these, they're SOL. The factor cannot come back to me, right? Okay, so what do? Well, first off, why don't we go ahead and credit the receivable for $1,200 because that's coming off the books because they're sold, okay? Then what? Then I'm going to sit here and I'm going to debit the cash, and up front, they're going to give me what? 1,000. They tell me what? They'll give me the remaining 100 if they can collect. So they're giving themselves a little margin there, aren't they? A factor margin, okay? And then the loss is what? The loss is $100. That loss is the 1,200 minus the 1,100, isn't it? Okay. Now what happens? Let's say the factor is able to collect the entire 1,200, so they're happy. So they say, hey, we're sending you the remaining 100. So we would debit cash for 100, credit due from factor for 100 because they're paying us the remaining 100, right? Okay. If the factor says, sorry, dropped my pen. If the factor says, hey, bum, I wasn't able to collect on those, I'm like, oh, well, too bad. That was a without recourse factoring. And so what'll happen? They're not going to send me the additional 100. So I'll just debit loss for 100 and I will credit due from factor. For 100. And if I look at the total loss on this deal now, it's what? It's that debit and that debit. So it'd be a 200 loss, the 1,000 versus the 1,200, the original receivable. And a company may do this because they're trying to generate cash flow, right? Okay. Now we've said that it could be with recourse, it could be with recourse. And when we said with recourse, it could be a pledging or it could be a sale. In order to be considered a sale, we must meet all of the following conditions, okay? And so let's flashcard that. And so what happens? The transferor, the seller's obligation for uncollectible account receivable can be reasonably estimated. The transfer surrenders control. Look, I can't say to them, hey, here's your money back, give me the receivables back. Can't do that. I've surrendered control. The transfer cannot be required to purchase the receivables. So you're like, well, then what's their recourse? Well, what I would have to do is I would have to say to them, okay, you couldn't collect on these receivables right here. You couldn't collect on these. I'll take these back and then take these two over here and go and try and collect on those. So I would simply replace the ones that they can collect on with similar receivables. And so that would be their recourse. And if I meet all those conditions, then I will treat it as a sale. I'll do the whole, thing that we saw up here with the journal entries, etc. If any of those criteria are not met, then it is what? It is collateralized borrowing. It's treated just like the pledging. Leave the receivable on the books and footnote that you had pledged those. Okay. Okay, good. Let's talk about.
So then if it's a pledging and then the factor, if it's sold with recourse and then the factor does collect them, then at that point, do they get removed from the books?
Yeah, once they've collected on those, then we can remove them from the book.
They've given you, or I guess my question is the recourse treated as a contingent liability, or is it because you've sold it, so they have the receivable and you have the cash, but then they collect, so then at that point you have to write off the receivable, right?
If any of the above conditions are not met, the transfer is treated as a loan. So it'd be like a collateralized loan. So you would remove the, you would leave the receivable as though you pledged that. So
And then,
you would
okay,
leave
so your loan would be repaid and then the receivable would go away.
correct.
Okay,
Yeah. Okay.
thank you.
Yeah. Guys, I want to start note receivable because then you could get into the module. Let me see, you could get in, you could finish this module. But I feel like I'm gonna just rush it if I do, and I don't want to do that. So I'm gonna stop, okay, unfortunately. So I think you got your work cut out for you anyway, because you got to finish chapter 2, and you can at least get through module 1 anyway, and maybe you could start to take a look at module 2. And if you see note receivable questions, understand that we haven't covered those yet, but I don't want to rush this, okay, because there's some couple things here, particularly when we deal with discounting a note receivable, that can be a little hard to follow, and I don't want to rush this. Okay. Question? All right, guys, keep up the good work. I will see you on Thursday. We will finish chapter 3 for sure. Okay.
All right.
Thank you, Professor.
Okay, guys. Thank you.
Bye.
Can I bug you for a second after class, John?
Yeah, let me just stop the recording so we don't have to record that.